This August reporting season will smash some businesses. The hit from the coronavirus, dropped guidance, and minuscule dividends. AMP Capital's Shane Oliver expects dividends to be cut by about 40%.
It's not just banking, it's companies outside banking which will likely cut their dividends. I think we've heard a little bit of that in the last week, with companies flagging that just preserving cash given the uncertainty.
And that's probably going to be okay, given low expectations.
The investment community said, well, this period's difficult. Come back to us next year with a dividend when you've settled down. It gives a chance to keep some cash on board.
Market expectations are that company earnings will be down by roughly 20%. After the US quarterly earnings season, we may see a similar pattern.
We have seen more companies surprising on the upside, something like 85% have surprised on the upside, which is above the normal amount of positive surprise. And we have seen earnings upgraded, but they're still down by about a third from where they were in the June quarter last year. So that may provide some guidance to Australia. We're going to see a hit. It may not be quite as bad as currently factored in.
Miners are to lead the charge, given skyrocketing iron ore prices.
Not only the result will look fantastic, which we already have seen from their production reports, it is the dividend and the cash flow is going to be really surprising people. The pure iron ore miner Fortescue is probably likely to talk about not just a dividend, a special dividend as well.
The Treasurer sees the iron ore price halving by the December quarter. But those closely watching the sector are optimistic.
There's only really one buyer, if we look at China as a buyer. And their steel industry is incredibly important. If we believe the comments we just made about will they stimulate and boost their economy, I think maybe not $115 a tonne, but halving seems quite difficult to achieve, I think. I think it stays at an elevated level.
Supermarkets are expected to be resilient, but they will likely flag challenges ahead. Woolworths, for example, closed 2 of its major distribution centres before the announcement that Melbourne was going into stage 4 lockdown.
I think they'll update and say, look, our cost base is elevated, but our top line is growing again after really spiking. So I think they'll be okay. Their commentary will be things are pretty good.
There will be disruption, but we do feel that the supermarket will be the defensive end. But moving forward 12 months, that does look like that there will be a bit of challenges in terms of growth.
Matt Kidman is expecting hefty property write-downs, meaning bad news for REITs, commercial property companies and shopping centres.
And where does the commercial property sector go? Retail property, we know the malls are going to do it a lot harder because retailers have found they can do a lot more online.
And those retailers could be a big surprise this season, especially companies selling electronics, white goods and furniture.
I think anything to do with the home and spending on the home could surprise on the upside.
But the question is, how long will the stimulus last, and whether the Christmas will be strong enough for them to pull forward into next year.
The biggest losers look like travel and tourism stocks.
But the issue is there's really no revenue at this point, and most of them can't definitively give guidance on how quickly things will come back.
Tech stocks have been a big winner stateside, riding out volatility to become a new safe haven for investors. But be warned, lofty valuations might not last forever.
There's a good chance that they get even more expensive, and we all have these eye-watering valuations that no one's really comfortable with, and that any growth stocks, which mainly sit in the tech area, will attach to that. But I think maybe them leading the market and gapping the market, that period may be up, especially if we get positive news on a vaccine the next 2 or 3 months.
We like Afterpay, we like Zip, and we like that whole sector. There's a lot of heat and hot money in this space, but we do feel $66 is a great buying opportunity, and the growth path for the next 3 to 5 years is enormous.
Only one big bank is reporting this season, CBA.
We do expect them to give somewhat of a weaker outlook, and there's a chance for their dividend to be a little bit disappointing compared to the expectations, simply because they paid a big dividend earlier on a few months ago compared to every other bank which deferred their dividend.
For investors, many of these results might be hard to swallow, but it could also be an ideal buying opportunity.
Strangely, out of a recession, there's always something good in it, and with corporate with companies, it normally is we get the cost base down because you've got to, that improves margins when things pick up.
The earnings profile for the next 2 years for the equity market actually is looking very strong, just given how much earning has been downgraded and cut. The blood was shed in March, and this is why we expect the result actually to be reasonably okay.